It's time for me to bring in Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us every week. Dhirendra, thank you so much for joining us. Let's get straight to our portfolio question. Well, Varun Singh has written in from Mumbai, Dhirendra. He's a very young man. He's currently still in his MBA college. He's getting a master's degree, but he gets a monthly stipend of 10,000 rupees. He tells us starting May next year, his stipend will go up to 50,000 rupees. And after October, which is exactly another year's time, he hopes to get placed and to make about 90,000 rupees a year. Now, currently he has parents who depend on him. He has an education loan of 4.5 lakh rupees, for which he's going to have to start paying an EMI of 9,000 rupees once his course is done. And his only investment is a ULIP plan, for which he's put already about 1.2 lakh rupees so far. He wants to know how he can start investing, and it's very interesting that he's thinking about it so early. He tells us right now he'll put aside 2,000 rupees from his stipend, and he'll keep increasing that money as he goes forward. Now, he has told us that he's used a personal loan instead of an education loan. He hasn't really told us why he's used a personal loan, but that tends to be a lot more expensive than an education loan. Would you like him to relook at his debt before he goes any further?
First and foremost, because of his dependent parents and his need to support them, he should certainly plan his term insurance. That should be the priority. Create that emergency fund quickly. So he should not think in terms of saving, making an investment into any fund or anything, but he should just start his recurring deposit, and he should build it up to a point that it becomes a reasonable emergency fund. And that emergency fund should get larger, because if next year he plans to get married, I don't think there is any other investment. His accumulation should be into a fixed income and a simpler thing which he can access anytime.
All right, Varun, it's of paramount importance that the first thing you do is get yourself a term cover. And Dhirendra, when we're talking about insurance, he has that money put aside in his ULIP. Now, what would you like him to do if he pulls that money out right now? Can he use it to knock off a portion of his loan, or perhaps start allocating it towards some of his goals?
Yes, I would say that, he can pull that money out. And before pulling that money out, he must get the term insurance. And term insurance will cost him much lower and a higher coverage. That apart, the remaining money can work as his emergency plan, his emergency fund. And then I think, all the saving that he has right now, that he can start investing. Given this backdrop, I think the plan can change a bit. He can start, conservatively investing. That can well go into a balanced fund.
Dhirendra, could you give him a balanced fund that he can use right now?
You can well consider the ICICI Prudential Balanced Fund or the Reliance Balanced Funds.
All right, Varun, on our screen right now are two balanced funds that Dhirendra Kumar recommends for you. Prioritize it that way. Make sure you have insurance. Make sure you bring down your loan amount. And like Dhirendra recommended, then you can start investing in a balanced fund. And you can use the money that comes out of that ULIP to allocate to all of these goals. Right, back to us if you need any more help. Let's take another question from another young viewer. 26-year-old Prasanjit has written in. He tells us he can invest 10,000 rupees every month for the next 25 years. He wants to know which mutual fund he should invest in to get long-term returns. He wants to create a corpus for his retirement, for his children's education. He's young right now, and I love it when viewers write in saying they have 25 years on their hands. And I assume that amount of 10,000 rupees will also increase as he gets older. Where would you like him to invest this money, Dhirendra?
He should consider one of the two, growth portfolios, either aggressive growth or the growth portfolio. And, most importantly, he should stick to the plan, keep investing, and keep watching this program as and when we review it, make those changes as well.
All right, so on your screen right now is our growth portfolio. Like Dhirendra said, we've been tracking this portfolio for you for the last 4 years. So stay with the show and we'll tell you if there's a need to make a change. In the meantime, you can just follow the portfolio as it is. Right back to us if you need any more help. Our next question comes in from a woman investor. Sumana has written in, Dhirendra, she says she'll receive a lump sum amount of 20 lakh rupees from her Provident Fund, and she wants to know where she can invest this money to receive a monthly income of 20,000 rupees and save tax. So for someone who has a lump sum and wants a monthly income, Dhirendra, what would you recommend she does?
Generating 20,000 rupees from 20 lakh rupee investment, and that too post-tax, and in a manner that it is tax efficient, is not easy. And that too, if you are going to depend on this income month after month. I would suggest that, combine the two. Invest a part of your money into senior citizen savings scheme. That will earn you 9% taxable, and if that's the only income, you will be below the threshold of the taxable income, and the rest of the money you should certainly 35% of your money should be invested into equity, maybe in a balanced fund, so that you don't get anxious as and when markets turn very volatile, and the return from that balanced fund over a longer period of time will be tax free. That apart, I'm hopeful that it'll be adequate enough to replenish the worth of your protect the worth of your capital. 12% return per annum drawn on a monthly basis looks difficult.
All right, so remember, if you have a question for Dhirendra, write to us. The email ID is at the bottom of your screen. And if there's something you'd like to ask us about from what you've heard so far, get in touch with us. It's time to look at our hold or sell segment. Well, Shamik Sharma has written in, Dhirendra, he's 33 years old. He began investing in mutual funds in 2006, and he tells us in an attempt to save tax and keep putting away money, he now has a portfolio that has 15 funds. He's heard advice on this show that says you shouldn't have more than 5 or 6 funds in your portfolio, and he wants to know what he can do to bring the number of funds in his portfolio down. Now, before we get into talking about the funds in his portfolio, I want to ask you first the list of questions that he sent in that are very important. He's worried about the way the market is functioning. So he's asking you, is this the right time to streamline his portfolio and withdraw money from his existing funds? Should he be waiting for a little longer? And should he be phasing out that withdrawal perhaps? Is that the better way to do it? So for all of our viewers who are watching right now, who are asking themselves the same question, is this the time to pull money out of a fund, even if it's for a good cause like streamlining your portfolio? Would you recommend it happens at this point?
Yeah, streamlining your portfolio, moving your money from, large collection to a select few, and that too thoughtfully. It doesn't matter. You should do it. Only thing you should be conscious of that, the tax implication. There will be a tax implication for investments that you have accumulated or bought in the last 1 year. Any gains on those investments will be taxable. So just plan your exit from such investments which you have accumulated over the last 1 year in a manner that you are able to, if there is no gains there, you can well move that money as well. If there is any gain, maybe plan your exit. But looking at his collection of 16 funds, it's a reasonably impressive selection.
But then he has a very long list of funds, and they all seem very impressive. I'm not going to go through the list because it's so long right now. I want you to just break it down and give him 5 funds that he can actually use to go forward. So off his list of really good funds, pick 5 of the best.
If I have to bring down his diversified equity fund to just 5 of them, I would choose Canara Robeco Diversified Equity, UTI Equity Opportunity Fund, SBI Emerging Business, ICICI Prudential Dynamic, and DSP BlackRock Equity Fund. And for all his tax-saving fund, I would like him to consolidate his money, move that money as and when it gets out of the lock-in period, and consolidate all of it into quantum tax-saving fund. And that's the reason why I haven't chosen the quantum long-term equity fund as part of his core portfolio, because both the portfolio, the tax-saving fund and the long-term equity fund, the portfolio is the same and performance is, almost similar.
All right, so on your screen right now are a list of funds that Dhirendra has drawn up for you. And remember, he said you don't have to worry about where the market is. It's always a good time to streamline your portfolio. Dhirendra, thank you so much for spending time with us this week and answering all of our questions. Remember, if you have a question for Dhirendra or any of our other experts, you can write to us. Email ID is at the bottom of your screen.